Hello, now we are going to have adjustments and accruals and deferrals. Okay, I say adjustments are there to bring the business account up to date. Adjustments should not be regarded as errors that took place in the accounting period. The matching principles. If you are dealing with accruals, you have to know what the matching principle is. This is an accounting rule that says to record revenues and expenses in the accounting period they occur. This will result to an accurate net income or loss by a proper matchup of revenues and expenses. Okay, let's take how supply is and let's do the adjustments. We said the beginning amount on the trial balance was 15,000. The first purchase was 2,000. Second purchase 1,500, and third purchase 2,500. And we have an ending balance of 10,000. Let's see how we amend this and at the end of the year and did the adjustments. Okay, so what you do is to add up the beginning balance, that's last year's. When you did your adjustment, this is what you have in your books. And during the course of the year, you made 3 purchases of supplies, and after you close your books, you said you have supplies 21,000 and the balance of 10,000 in the books. This is the balance of 10,000. So you add what you had first and all your purchases. So it's gonna give you 21,000 minus the ending balance that you have reported in your notes. So this is the 10,000. So if you deduct the 10,000 from the 21,000, you're gonna have 11,000 supplies. This is the one that was used in the year. So this automatically becomes your expenses. This is how you do your journal entries for your supply expenses. So you say supply expenses, you debit the 11,000 and you credit the supplies. Okay, so let's do something with depreciation. So we say this expense is a result of the allocation of the cost of a long-lived asset over the length of its production period. Okay, so we also have accumulated depreciation. Accumulated depreciation, we say this is a contra asset that determine the asset book value, where the total depreciation expense is recorded every ending of an accounting period. This is therefore a long-term credit account. Like every year you calculate your depreciation, is recorded to accumulated depreciation. The total is transferred to this accumulated depreciation as a credit. Okay, and what do we say about these things to remember? You have to remember this formula. As long as you're studying accounting, you have to keep this in your head forever. That depreciation is cost minus salvage value over number of useful life. This is gonna be a straight line method, but when we get to depreciation, the types of depreciations, I will tell you how this works and how you differentiate them with other formulas. So we say cost of an asset minus accumulated depreciation equals to the book value. You will know this when we treat the different depreciations. Okay, so we have this example here. Let's see how we handle this. With the Alfred company purchased an equipment on April 1st for the amount of 25,000 with an estimated life of 5 years and a salvage value of $1,000. What is the adjusting entry for the year? Remember, this asset was purchased when? April 1st. And the entry we are supposed to make is December. 31st. Okay, so you use this formula: depreciation equals to cost minus salvage value divided by number of useful life. Okay, the asset cost $25,000 and the salvage was $1,000 divided by the useful life, which is 5. So this will give you 4,800. But what you have to remember is the asset was bought when? We're gonna know very soon. So we said the year depreciation is 4,800. So this asset is expected to depreciate every year 4,800. But being that this asset was purchased in April 1st, so for you to get the month depreciation, you have to divide 4,800 by 12. So it's gonna give you 400. Now 400 times 9 months, because from April to December 31st is 9 months. So you have to times this. So 9 months times $400 per month of depreciation. So it's gonna give you 3,600. Now you do your journal entry. So as we say, these are credit accounts. So you say depreciation expense is 3,600, and accumulated depreciation is 3,600. If you are to do another year, the other year is gonna be here on depreciation expense 4,800. If you are going to do another year, let's say this is 2014. Okay, if you bought this 2014, this is your entry. But for 2015, December 2015, this is gonna be the full amount, 4,800, right? But we're gonna deal more with this when we get to. This is just a preamble. Okay, now we jump to accruals, deferrals, revenues and expenses. Okay, we say accrue means to accumulate when revenues and expenses are on in the current accounting period but not recorded at the end of the period. Okay, things to remember. This is just, we are just touching some bases over here. We said the accrual basis provide a better understanding of the company operating activities. The income statement reports only revenues on and expenses incurred to earn the revenues during the year. All assets that were on and liabilities incurred are reported. So this is just a little difference between accrual method and the cash method. So this is something that people have to remember especially when you're dealing with accruals, because most businesses this day deal with the accrual method. Okay, so the accrual method reports revenues in the income statements when on, while the cash method reports revenues in the income statements at the time the customer paid the cash. The second one says reports expenses in the income statement in the period they occur or used or expired. Here, when the customer pay the cash or when the cash is paid, you report that to the income statements. So these are some critical items that people need to understand. Otherwise, your accounting method is gonna be questioned. Okay, so I'm presenting some examples as we go on. So this is with a accrual interest expense. Okay, what I said here, I said like interest on notes payable, which is interest that is not paid until maturity date. So here there is a postponement over here. Okay, so with this example, let's see what this example. We say Alfred Company signed a 10,000 5-month notes starting on October 1st, 2014 with a 12% discount payable on due date. Okay, so this is what they ask us to do: to record December 31st, 2014 adjusting entries for accrual interest and to record payment of the notes and the interest on the due dates and the revising entry. Okay, so the first time we talk about revising entry here. Why do we talk about revising the entry here? Okay, every time there is a deferral of payments, you have to do revising entries because these are very important. Okay, as long as there is a deferral, okay, for you to be able to match your revenues and expenses. Okay, and this help you the reversing entries also helps you for you not to go back to the previous year and look at the information. So by revising them in the following year, so you will be able to see what really happened last year. Okay, so this is a breakdown of this thing. So we said notes, I mean date of notes. The date of note was October 1st. End of period was December 31st. Okay, and maturity date was 28 February 28th. Okay, so you will count from October 1st to February 28 is 5 months. Okay, so because we are dealing with accruals, and according to our matching principle, we have to match what we know we have to we have accrued here, so that we can do our accounting method correctly. So let's see what we do here, how we calculate this to get the 300. So we say the $10,000, which is this, times the 12% times 3 months. The 3 months is from October 1st to December is 3 months. 2014 is 3 months. So this is gonna give us $300. Or another way to calculate that is 10,000 times 12%. You change it to a fraction times 90 days divided by 360. 360 is the bankers here, so it's gonna give you 300. Okay, and this is from January 1st to October 28th. So this is the following one. Okay, so this is how we do our journal entry here. This is what we are required to do to record December 31st adjusting entry. This is our adjusting entry. Okay, this 300 is our interest expenses. This is our interest expense that we are supposed to pay in the first place. Okay, so it's 300 right here. So we say interest expense and interest payable 300. So on October 28th, what happened in October 28th? This look like this is a payment of the note. Okay, remember when the note was, when you took the note payable, okay, it was a credit, and now when you are paying it, you have to debit this, okay, with the interest. Remember, you already had an interest for last year, which is this interest payable, and an interest expense for this year, which is this. Okay, so with the interest you have to pay, the cash is gonna be 10,500. You revise the entry here because they asked us to do revising entry. So remember when I told you why do you do revising entry? Okay, so for you not to go back to the previous year, so you revise the entry over here. So now if you are asked okay, so notes, you have to record notes payable 10,000, interest expense 500, and cash 10,500. Okay, okay, accrued revenues. Accrued, these are revenues that have been earned in one accounting period but not received until another accounting period. This turns to be an asset. You already earn something, but you will never receive it until the following period. Okay, let's say, bring this example. Alfred Company has a 5,000 notes receivable, 120 days with 11% interest, dated November 3rd, 2015. Okay, so how they want us to calculate the accrued interest for December 31st, 2015 and prepare adjusting entries, and January revising entries. Okay, so how do we do this? First, you have to know the date of the note. The date of the note was when? November 3. This was when this note was given to Alfred Company. Okay, so from November 3rd to December 31 is 58 days. Remember, this is telling you about days. The previous example was telling you about months. So if you are asked to do days, you have to count the days individually. Okay, calculate the days individually. If you are asked to do months, you have to go by the months. Okay, this is the difference between in the language of accounting. Okay, if you are given days, do by the days. If you are given months, do by the months. So from the period of maturity is from actually is from November to October to March 1st. Okay, but the maturity date is March 2nd. Okay, is March 2nd. March 2nd is the maturity date. Remember, 2016 is a leap year. So if you calculating this, you will not get, if you get March 1st, you are wrong, because February was a leap year. So you have to take account of the leap year and count it here, because we are dealing with 2016. Okay, so it's 62 days from January 1st, to March 2nd is 62 days. Okay, remember this is 120 days of notes that we receive, so the maturity date is there. So let's see how we calculate that. We say 5,000 times 11% times 58, which is this 58, for us to calculate our accrual interest. This is calculate your accrued interest. This is the accrued interest. This is interest that we already earn, but we are not going to receive this until the next accounting period. But for us to match our revenues and expenses, we need to report this in our books. So this we're gonna do adjusting entries. So by so doing the adjusting entries, this is how it's gonna look. Interest receivable is $88.61, and interest income is $88.61 credits. Okay, this is just ways of calculating it. You can either calculate it this way, or you calculate it longer way. This is the longer way. Okay, but the most important thing is for you to get the days. Once you get the days, then you are able to calculate this more easily. Just don't forget the days of the months. You have to remember those as an accounting student. Okay, so these are our revising entries on January 1st. January 1st, if we revise the entries, this is how your entry is gonna look. You are revising this. So to revise this, you just have to flip this. Okay, now instead of this, you say interest income $88.61 and interest receivable days. But at the end of the period, at the end of this period, you will receive $1,833. $183.33 at the end of the period. This is the interest that you will receive for holding these notes onto 120 days. That's a good amount. Okay, so let's look at accrued expense example on salary expense. Okay, say Alfred Company has a 5 days work week with a payroll of 5,000 and December 31st 2015 fall on a Wednesday. Okay, so the payday is Monday through Friday, and the December 31st, when does it fall? It fell on a Wednesday. So they asked us to do this to December 31st adjusting entry for the unpaid salary, the payment of the salary on January 2016, revising the entries. Okay, if entry C were made, prepare January 2016 entry for payment of salary. So let's see how we do this first. This is our solution. Okay, so 5,000 divided by 5 days is 1,000 per day. Okay, so Monday through Wednesday is 3 days. Okay, so if since December 31st fall on a Wednesday, is 3 days that you have to pay the salary for you to do the matching principle. Okay, so now you say $1,000 times the 3 days that you have to pay, because the January and the December 31st fall on this day, on a Wednesday. So at this date you have to record that expense on that year. So 1,000 times 3 days is 3,000. So this is our entry as of this. So A, adjusting entry. So salary expense 3,000 and salary payable 3,000. Okay, and B, the payment of salary on January 2016. So if you are paying the salary on January 2016, this is how your entry is gonna look. We say salary expense 2,000, salary payable 3,000, and cash 5,000. The C, revising entry. So if you are doing revising entry, you are going to revise this. Okay, you are going to revise this over here. And the D, if transaction C was made, which is this transaction C was made, prepare a January 2016 entry for payment of salary. So if this was made, so how are you gonna prepare the payment of salary? The payment of salary is gonna be salary expense. It's 5,000. You're gonna pay the full amounts on this time. Salary expense 5,000 and cash credit 5,000. Okay, for the payment of salary. So you already pay your employees. Okay. So deferred. Deferred means to postpone. When you postpone something, you defer. Okay, deferred expense. We say this is a payment for goods and services that benefits more than one accounting period. So we think about insurance when we see something like this. Okay, so let's bring an example. On August 1st, Alfred Company paid 3,600 insurance coverage for 1 year. Okay, the fiscal year was 2014. So they require us to record the December 31st adjusting entry, December 31st 2014 deferred expense, and to record December 31st 2015 insurance expense. Let's see how we do handle this example. Okay, so 3,600 divided by 12 years is 300 per month. Remember, the insurance was paid on when? On this date, on August 1st. Okay, so from August 1st to December 31st is how many months? Okay, it's gonna be 5 months. Since we are doing the accrual basis of account, we need to report the expenses and revenues that we incurred during this period. Okay, so for us to do that, let's see how we do our adjusting entry for December. So this is our insurance expense is 1,500, which is 300 per month times 5 months. The 5 months come from August 1st to December 31st. It's gonna give you 5 months, so it's gonna give you $1,500, which is you debit insurance expense 1,500 and credit insurance prepaid 1,500. Okay, so the second one says to record the deferred expenses. So deferred expenses, so you still have in the bank 2,100. Okay, so this is deferred insurance expense 2,100. Okay, and to record December 31st expenses, so 2015. So insurance expense is gonna be 2,100 and prepaid insurance 2,100. Okay, and your entries are done for the year. Okay. So now is deferred revenues. We said deferred revenues is revenues that is already received in the accounting period, but service is not fully provided till another accounting period. A matching principle is needed here to show the amount on and revenues deferred. Okay, so we have this example in October 31st 2014. Alfred Company collected 4,800 on a 6-month lease. Okay, so Alfred has his own building and he leased this building and he collected this kind of money, 4,800. So we have to record the adjusting entry. Remember, this transaction happened on October 31st. Okay, so for us to do our matching principle, we need to report the December 31st deferred revenues. Okay, and let's see how we do our stuff here. So we say from October 31st to December 31st is 2 months. Okay, so for us to get the per month, we have to divide the amount of money that was paid for the months. Okay, so for 6 months he received 4,800. So you divide this by 4,006 divided by 4,800 divided by 6, it's going to give you 800 per month. So 800 divided by 2 months, which is October to December, it's going to give you 1,600. So let's see here our adjusting entry, how it's going to look. So so we have on rent 1,600 and rent income 1,600. Okay, and here our deferred revenues, how much do we defer? 4,800 minus 1,600 is gonna give you 3,600. So this is deferred. We're not gonna receive this until the next accounting period. Okay, so now in 2015, this is how this deferred rent is gonna look like. On earned rent 3,200 and rent income 3,200. Thank you. And now our next topic is gonna be dealing with accounts receivables and notes receivables. So we're gonna have to deal with accounts receivable, the different methods of accounts receivables. Okay, all right, so until then, I see you. Thank you for your patience and thank you for watching.